Namaskara. So, in last session we have seen some of the turnover ratio. So now we will study some other ratios, and here first of all we will see working capital turnover ratio. So this is also one of the turnover ratio. So here working capital turnover ratio we will see it is calculated by dividing net sales by net working capital. So net sales we have seen, we have studied, and also net working capital is also we have studied. So here first of all see working capital is actually expressing the relationship between net sales and the net working capital. So here first of all the net sales means see total sale, that is total sale. It is also calculated by adding cash and credit sale after deducting sales turnover. So sales return. So here net working capital is nothing but it is sum total of current assets and current liabilities. That is the current assets minus current liabilities. So here, so no standard is required for the working capital turnover ratio. High working capital turnover ratio means over trading, and low working capital turnover means under trading. Both are not good for the organization. Over trading is also not good for the, not healthy for the organization, and also the low capital turnover is also not healthy. So therefore here, so it should be not higher or lower, it should be just normal. So when we come to working capital turnover ratio, here higher working capital turnover ratio is also not so helpful for the organization. If the capital turnover ratio is less, means also it is also not helpful for the organization. Both are not so helpful or healthy for the organization. It should be at normal. So here we will calculate the working capital liabilities, that is working capital turnover ratio. How the working capital turnover ratio is calculated. So first we select a problem, that is cash sale is 9 lakh, credit sales is 13 lakh, current liabilities 2,50,000, sales return from the credit sale is 2 lakh, current assets rupees 6,50,000. So this is the given information. So from this we have to calculate working capital turnover ratio. So first of all we will see how the working capital is calculated. Already we know how to calculate working capital. So working capital is calculated by deducting current liabilities from the current assets. So here we will see what are the current assets and what are current liabilities which are given in this problem. So current assets, as per the problem, current assets given is 6,50,000 and current liabilities are 2,50,000. So here if we deduct current liabilities from current assets, means 6,50,000 minus 2,50,000, we get working capital as 4 lakh. So net working capital is 4 lakh. So after that now we have to calculate net credit sales. So we know the credit sales, how to calculate credit sales. So credit sales, if the total sale is given, from that you have to deduct cash sales and sales return. But here credit sale is given in this problem. So credit sale is 13 lakh and the sales return is 2 lakh. So here after deducting sales return, so here 11 lakh will be the net credit sales. So after getting net credit sales, so now working capital turnover ratio equals to net sales divided by net working capital. So already we know net working capital, that is net sales, is already it is given in this problem. So net sale is 20 lakh and net working capital is 4 lakh. So if we divide net sales divided by net working capital, that is 20 lakh divided by 4 lakh, means we get the working capital turnover ratio as 5 times. So here it shows in times, because it is here the working capital turnover ratio is expressed in terms of times. So like this the working capital turnover ratio is calculated here. Important aspect is calculation of working capital and calculation of net credit sales. So we know the current liabilities and current assets are most important terms to calculate working capital, and After that we are going to calculate net credit sales, and after that we calculate working capital turnover ratio. Now we will find out capital turnover ratio. So next one is capital turnover ratio. Here it is calculated by dividing net sales by net capital employed. So here we know, yesterday we have studied how to calculate net capital employed. So it is shown the rate at which capital invested is rotated in normal course of business. How the capital invested is rotated or reused in normal course of business. So calculate here, simple problem is calculate capital turnover ratio from the following information. So sales is 3,10,000, sales return is 10,000, and capital is 4,50,000. So here first of all we will calculate net sales. So net sale is calculated by deducting sales return from total sales. So here total sales is given as 3,10,000. From that sales return is 10,000, we have to deduct. After deducting sales return we will get 3 lakh as net sales. After that we are going to calculate the capital turnover ratio. Here net sales is divided by capital employed. So we have to see whether the capital employed is readily given in the problem, or we have to calculate. Working note is important. So here in the problem it is clearly given that capital employed is 4,50,000. So there is no question of calculating the capital employed separately. So therefore here if we take the two values, so net sale as 3 lakh and the capital employed is 4,50,000, we get capital turnover ratio, means the capital is rotated in normal course of business for 0.66 times. So it is very clearly it is given that 0.66 times the capital is rotated in the business. So here next one is fixed asset turnover ratio. So fixed asset turnover means it is calculated by dividing net sales by the net fixed assets. So net sales divided by net fixed assets. So fixed asset turnover ratio equals to net sales divided by fixed assets. So fixed assets turnover ratio, net sales is given here. Net sales, we know that how to calculate net sales means net sales equals to total sales minus sales return. After deducting sales return from sales we will get net sales, and net fixed assets means total fixed assets minus depreciation is called as net fixed assets. After getting these two things, now it is very easy to calculate fixed asset turnover ratio, that is net sales divided by fixed assets. So fixed turnover ratio is expressed or expresses the relationship between the net sales and the net fixed asset. So now after studying all the 4 types of ratios, first one profitability ratio or liquidity ratio or turnover ratios, and the leverage or solvency ratios. Now it is time to study the theoretical aspect. We have completed how we have studied almost all the ratios in brief, and with the examples, with simple problems we have studied. So now we will move to exercise problems, that is 5 marks problems. First of all we see, then 15 marks also problem, 15 marks problem also we will study. So first of all we will select only 5 marks problem. From the following information calculate current assets, current liabilities and stock turnover ratio. So 3 informations we have to calculate here. One is current assets we have to calculate, current liabilities we have to calculate, and stock turnover ratio we have to calculate. So here the given information is working capital rupees 75,000, current ratio is 2.5:1, and the net sales given is 4,80,000. So opening stock is 24,500, closing stock is rupees 35,500, and the gross profit ratio is 25% on sales. So these are the given informations. From this information we have to calculate the stock turnover ratio, and we have to calculate current assets and current liabilities. So first of all we will see here what are the given informations. Here current ratio is 2.5:1. Therefore working capital ratio will be current assets minus current liabilities. So working capital ratio will be current assets minus current liabilities. So here current asset is 2.5 and the current liability is 1. So if we deduct to 1, that is the current liabilities, that is 1, from 2.5 we will get working capital ratio as 1.5. So here after getting 1.5, now it is time to calculate the amount, that is the total amount, that is 75,000 into 2.5 divided by 1.5 means we are getting 1,25,000. So current liabilities is current liability ratios divided by working capital ratio into working capital amount. So here we got 1,25,000 as current assets. Now we have to calculate current liabilities. So 1 divided by 1.5 into 75 means we are getting liabilities, current liabilities as 50,000. So here first from the given information we have to calculate current assets, then we have to calculate current liabilities. So by using the some equations we have calculated the current assets as 1,25,000 and current liabilities as 50,000. So now here gross profit is given as 25% on sales, means it is 1,20,000. So almost 1,20,000 means the total sale is 4,80,000. From that 25% means 1,20,000. So after calculating gross profit, now it is very easy to calculate cost of goods sold. Cost of goods sold equals to net sales minus gross profit. So here net sales is given as 4,80,000. If you deduct the gross profit 1,20,000, then we will get the 3,60,000 as the cost of goods sold. So here when the cost of goods sold is calculated, now it is very easy to calculate stock turnover ratio. So stock turnover ratio is nothing but stock turnover ratio is calculated by dividing the cost of goods sold divided by average stock. So here cost of goods sold is calculated as 3,60,000. Now it is time to calculate the average stock. So we know how to calculate average stock. So here average stock is calculated by dividing the opening plus closing stock, and here opening stock is 24,500 and closing stock is 35,500. So here totally we are having the information, that is 60,000 as total stock, divided by 2 means 30,000 we get the average stock. So by dividing cost of goods sold by average stock we will get 3:1 as the ratio. The following information of Sunil company is given. The current ratio is 3:1, acid test ratio is 2:1, current liability is rupees 50,000. So this is second problem. Here we have to find out current assets, liquid assets and inventory. So here in last problem we have seen how to calculate current assets and current liabilities. Now here now we have to calculate the liquid assets and inventory. So first of all, the given information is that current ratio is 3:1. So current ratio means here current ratio is calculated by using the formula current assets divided by current liabilities. So first of all we will see whether the current assets and current liabilities are given in the problem or not. So current asset is not given, only the current liability is given. So ratio is 3 and the current asset is not given, the liability is 50,000. By cross multiplication we get 1,50,000 as the current assets, means 3 is multiplied with 50,000 liability, it will be 1,50,000. Next, acid test ratio. Acid test ratio means it is nothing but it is a quick ratio. So here liquid ratio. So liquid ratio equals to liquid assets divided by liquid liabilities, which is equals to 2:1. Here by cross multiplication again we will get 1 lakh as liabilities. So finally we can calculate inventory as current assets minus current liquid assets. So 1,50,000 minus 1 lakh we get 50,000 as inventory. So when we take a second problem, so Ashoka Limited has furnished the following information. Ashoka regarding its current assets and current liabilities. Cash is 10,000, creditors is 60,000, debtors is 58,000, bills payable 32,000, bills receivable 10,000, outstanding expenses 16,000, marketable securities 30,000, stock 1,04,000, prepaid expenses 4,000. Here we have to calculate current ratio. Only we have to calculate current ratio. We already know current ratio can be calculated by using the formula current assets divided by current liabilities. So first of all, from the given information, we have to calculate the total current assets, then we have to calculate total current liabilities. After getting current assets and current liabilities, we have to divide the current assets by current liabilities. So here we will see how to calculate current ratio. So current ratio is equals to current liability assets divided by current liabilities. Here in the given problem, the current assets are given as cash 10,000, debtors 58,000, bills receivable 10,000, marketable securities rupees 30,000, stock 1,04,000, prepaid expenses 4,000. So means we are getting here total current assets as 2,16,000. And next, current liability is equals to creditors plus bills payable plus outstanding expenses. From the given information, we have taken the creditors, bills payable and outstanding expenses, and the sum total of these three is current liability. So here current liability is creditors 60,000, bills payable 32,000 and outstanding expense 16,000. So total we are getting as 1,08,000 is current liabilities. After getting current assets and current liabilities, we can easily calculate current ratio, which is equals to current assets divided by current liability, means 2,16,000 divided by 1,08,000, which is equals to 2:1. So here the current ratio is 2:1. So therefore, like this, the ratios are calculated. And here in this session we have started the 5 marks question. We are seeing exercise problem, we are calculating or we are solving the exercise problems here. And here in first 3 problems we have seen how to calculate the current ratios and current assets and current liabilities, all the things. So I hope it is understood by you and all. So thank you one and all.